Thanks for tuning into Talking Point. I'm your host, Nitin Shah. A special conversation lined up today with the MD and CEO of one of the largest wealth management businesses in India. And it'll be very pertinent to get his thoughts on the Indian landscape currently as they see it or as he sees it, as well as the opportunities for Indians maybe on the global landscape as well. We'll try and squeeze in a question or two to Nitin Jain. He's the MD and CEO of the Edelweiss Wealth Management business, joins us right now on the show. Nitin, so good having you. Thanks for joining in. Hope all is safe.
Thank you, Neeraj. Everybody's great. And I hope the same is on the other side.
Yeah, touch wood. All of us safe and fine. Thanks. So, Nitin, it's an interesting time because same time last year, it's nearly been a year, right? Or almost a year, wherein we were on the throes of despair, so to say, mentally, if not actually, and the beginning of the COVID wave. And now, despite the cases surging yet again compared to what they were a month ago, we are amidst the vaccination drive, and therefore the sentiment might be remarkably different. What is it that you guys sense wherein you're doing this multitude of things, which is managing money as well as trying to tell people to maybe come and invest in the variety of products that you guys dish out? What has been the response? What is your own approach towards, or your firm's approach towards investing currently?
No, amazing, Neeraj. It's been one of the craziest years in that sense of my career. In the last 20 years, I just finished 20 years of my professional journey, and I have never seen something like this. And probably none of us have, right? Given the kind of crisis that we saw, probably once in a century event. But what is unbelievable is how all of us have bounced back as a community. And it's unthinkable. I think if somebody had asked me 6 months back where we would be today, and what we are seeing today is completely different, right? So whether it is about how we are conducting our lives today, to how businesses are seeing things today, how the government has reacted, and I mean, it's just unbelievable. In fact, I would go to the extent of saying that I've never felt more optimistic about India's future. And it's as if we were waiting for a crisis to happen for this to be a catalyst for this kind of a growth to get triggered. I was sharing with some of my team members that this just feels like 2003 to 2008 for me. Just to share with you some numbers, this year most likely we are going to see earnings of 500 odd at a nifty level, Neeraj. Okay. This is around 15% growth in earnings over last year. In a year where we had a lockdown for more than 8-9 months, you are having a 15% earnings growth over the last year. And our estimate is we will have a 30% earnings growth over this year, next year. Yeah. And we are constantly revising it upwards. We have not seen this kind of a growth momentum over the last 20 years in India. So this is what has happened fundamentally because of this crisis is something very spectacular. So we are feeling very positive about the market, not only equity markets, overall the business cycle has started. The optimism is back, liquidity is back. So we are very bullish and we are talking to investors in the same light. You should not confuse that with our view on Nifty in the next 6 months or 12 months. But over the next 5-10 years, our view on India business cycle has turned meaningfully, and we are very optimistic about that.
Okay, now let's tie this in with the couple of wrinkles or the couple of odd events around which might not disrupt the party, but maybe impact the party, if you will. What have you made of this whole fear of rising inflation and rising yields? And they may move in tandem, and at times you don't know which is the precursor and which is the subsequel, so to say. But how do you guys feel about this particular fear that is lurking around and the impact that could have on equities and risk sentiment at large?
Absolutely. I think in any bull market, the only thing that can puncture the bull market really is high real interest rates. Okay. But the reality is with growth always comes some level of inflation. But I think it will be too premature to start talking about high interest rates and high inflation, especially in a country like India, where we have dealt with 14-15% inflation over a long period of time and have seen major growth. I do think inflation coming back globally, but for good reasons. The good news is that the inflation is coming back not for bad reasons, but for good reasons. And uh, when demand comes back in such a strong way, so much stimulus has been pumped in, there will be some level of asset price inflation, which we are going to see. I think this, my view, and I don't think this is still a consensus view. The era of negative interest rate might be slowly, coming back to neutrality. So that is going to happen, and we might see more normalcy in interest rates. But this is not a bad news for me. This is a sign that the market is becoming more bullish about the future growth prospects globally as well as in India. And I think RBI and all the central banks, if you saw even today's interview, it was very clear that the central banks are very progressive and they're very focused on growth. So this is one big thing that changed because of COVID, right? Always you will see central banks and the governments at a crossroad, right? One is the accelerator, the other is a brake. For the first time, because of COVID, even the central banks have understood that they have to support the growth. They cannot be a big brake. In fact, right now, government is a big accelerator, and the central banks are a small accelerator. So this car is being driven with two accelerators, not accelerator and a brake, and that's why the growth is picking up in such a big momentum. So I'm definitely, we will have to keep a watch on the interest rates, rising yields, and it will create volatility for sure, 100%. But I'm not very worried when I look at the next 5 to 10 years.
Sure. So maybe some of your clients actually have that longer view as well. But would you reckon that the volatility could be accompanied by, say, some downward pressure because the markets in its wisdom might believe that they have priced in a lot of positives? Or would you believe that slightly better economic growth on a YY basis, it will look very good because of the base effect, and this 25-30% earnings growth that we might see, and well, God willing, we'll see a surprise there too, would take care of some of these issues?
No, absolutely. I think what you're trying to hint at, and I would put it more clearly, we ourselves feel that the markets have factored in a lot of upside already. And that's the nature of the beast, right? Markets do try to factor in long term. So I'm not the only one who can see this long term upside in the markets, right? So we are all trying to make our own assessments. But that's the nature of the market. I don't feel comfortable at these valuations making meaningful allocations for our clients in equities. That's clear. Maybe we need some kind of time correction, some kind of price correction for us to go really with a lot of conviction in the markets. But again, we have to put this in perspective. If you adjust for 6 months or 12 months, these valuations will start to look reasonable. And hence, what we are telling our customers or clients is, do not make incremental allocations in a meaningful way to equity, but do not sell. So stay put and find other alternative ways of getting into risk assets. For example, we have launched our fund called Edge Fund. It's a long short fund, which is benefiting not only from the fact that the markets are doing well, but also benefits from the volatility in the markets, and is more absolute return oriented and try to deliver 10 to 12% without the drawdowns of the market. So those kind of products are in the market. We are looking at private markets. I think there is a significant gap now in the private markets and the public markets. We launched a pre-IPO fund. If you look at where the companies are doing their IPO versus where they're getting listed, because of the flows of the retail money that is coming in the markets, the gap is meaningfully wide, right? So there are other ways of playing the market more smartly to get the same beta, but you have more margin of safety. And that's some of the suggestions and the ways in which we are trying to play the markets. But currently, I agree with you. I think there is definitely less margin of safety at these valuations because you are factoring in a lot of upside.
Okay. The other question, Nitin, and I'm presuming a few things, so please correct me if I'm wrong, but because of the fact that you would be investing significant portion of the Indian money in various assets in India and maybe across the world, and you would be having a fair degree of global wealth coming in to you to be invested within the Indian landscape. Where is it that you're seeing more more traction and more chutzpah out there? I mean, are Indians over the last 3, 4, 6 months really vociferously parking money in equities? Because we know they're doing it directly. Maybe they have taken money out of mutual funds, are doing it directly, but we know that the Indian retail guy is doing it directly. Is it happening in a big way at the HNI community through wealth management firms? Or do you see a larger proportion of global money coming into you guys to be invested within the Indian landscape?
So maybe I'll just give you 2, 3 key trends that we are seeing from where we sit. And you highlighted some of those yourself. So one, I think there is a very strong trend towards disintermediation. It's very interesting. It's very interesting that you're seeing flows away from mutual funds, but retail going directly into the markets in equities. And by the way, Neeraj, we are seeing the same thing in the bond market.
Okay.
And that's even more fascinating, right? Because you're not seeing so much inflows in the debt mutual funds, but you see the success of the debt issuances of the companies that are coming out with the public issues. Massive success. And there is massive demand for debt papers in the market. And people are saying, we just want to see what we are buying rather than giving blind pool money to fund managers. And I think there are some high quality fund managers who are still getting money, but that there is some level of disintermediation that we are seeing going direct to the market, both in equity and debt. So this is one trend that we are seeing. Second, I think that you highlighted, very interesting. For the first time in the last 5, 7 years, we are starting to see the Indian sophisticated investor starting to see the benefits of diversification, which means asset allocation, including global diversification. So, okay, can we buy stocks in US? That can be done through mutual funds. Edelweiss mutual funds have launched funds like US Tech Fund, Great Offshore China Fund, etc., etc. There are also interesting organizations which have created access to US markets where you can actually buy stocks directly. So I think that phenomena is picking up. People are actually starting to diversify, not only in the ultra high net worth, but also in the affluent segment. It's a very interesting phenomena, and I think this will take off in a meaningful way over the next 5, 10 years. In fact, it has happened in China, it has happened in Brazil, it will happen in India also. But we were late to the party, but it's getting started. So this is the second, I would say, big trend that we are seeing. The third is the alternatives wave. This is a massive wave. This is an absolutely massive wave. You have seen what has happened in the mutual fund industry. In the last 5 years, it has just gone through the roof, right? Because of financialization of savings. It started with demonetization, in my view. 2015-16, when the demonetization happened, that was the catalyst. Tons and tons of money moved into the financial sector and largely went into mutual funds. Now what we are seeing is, as interest rates have come down, as people have realized the benefits of financial assets, now they're trying to understand the benefits of, or trying to understand how can we create better risk-adjusted outcomes. And more sophisticated fund managers are coming in. AI regulations have become stronger. There is a wave of alternate asset managers coming to the market, and the customers are becoming more and more sophisticated, and they're more understanding of the products. We are seeing a 40-50% CAGR growth in that segment. So we think this will continue for the next 5 to 7 years at least. And my view is, in 2025, the revenue of the mutual fund industry and the alternate industry will be nearly similar.
Wow.
So that is the third trend that I would say happening. So these are the 3 trends that I would watch out for. And the fourth, which is not India money, but the global money coming to India. And there, my focus is always a lot more, Neeraj, on the long-term money, because that's the channel where I have interacted more, and we have done more business, which is FDI and pension funds and sovereign funds, etc. What we have seen, there is tremendous demand tremendous demand for assets. Okay, so you will see a huge amount of asset buyouts, particularly in infrastructure. Okay, so, and somewhere I feel it's great, and somewhere I feel that maybe we should incentivize even the domestic companies, domestic institutions to play this game. So, for example, I do feel there is no reason why Indian insurance companies should not be buying Indian roads. There's no reason why Indian pension companies should not be buying airports or ports. And why should we wait for the global pension companies to buy them? And there should be healthy competition between global as well as Indian companies. But the way the current regulations are, it is very difficult for the Indian institutions to acquire these assets because of their charter in terms of investments, etc. But what I do see is global money chasing Indian assets because that is hunger for the yield. And these are beautiful assets, 30, 35-year assets. In some sense, you're also seeing a reflection of that in form of success of InvITs, REITs in the retail market. So most of these guys are acquiring these assets. Part of that they're monetizing through, coming back to the markets in terms of REITs and InvITs, etc. But this is the fourth trend that I would think is a big one that I see.
Actually, so Nitin, can you talk a bit about that? The fourth point that you mentioned, because that has tremendous, how do I say it, relevance with the current whole opinion in the market that there will be a shift and a rotation from high quality, highly valued growth companies into the cyclicals, and infrastructure is a classic theme there. Now, my question is, we've typically seen infrastructure creators not really generate that much of shareholder wealth, right? In the past, be it power companies, be it road construction companies, etc. Of late, the Adani Group is an example of how things have really mushroomed into wealth even for the minority investors. But do you reckon this can be replicated across the sphere? Power companies, power transmission companies, road construction companies, and what other forms could come to the fore from a listed minority shareholders perspective?
My view is there is a high probability of that happening. This is a very probabilistic market, right? Never, but my view is there's a high probability of it happening now. And I will give you two simple, one anomaly in the market, which is just an interesting intellectual thesis, frankly, more than anything else. So one, I think in a market where there is low growth, okay, which is the market that we saw between 2013 and 2019, there was a lot of uncertainty and low growth. There was a lot of premium for safety, okay? And there was a lot of concentration in a select few names. And, it creates momentum in those stocks. Like, I don't want to name the stocks, but we all know the high quality stocks and all of that. So, and they have got traded at 55, 60, 65 times. And when I do the reverse calculation of those, you're effectively giving cost of equity at 8-9%. So it's like, even if I project those earnings for the next 25, 30 years, basically you have to assume that you are going to get a 8-9% earnings, unless we are so horribly wrong in terms of assessments, which is possible. But at 60 times earnings in a mature market, going wrong is in terms of earnings, what should you say, prediction is, you can't be off by too much, right? So what you're doing is you're giving very, very low cost of equity to those, but it's a crowded trade, right? Because you don't want to be missing out, right? And that's what has happened in those stocks. But there was no growth in the other sectors, and that's why there was a scarcity premium to these stocks. Now, things have changed. You only talked about inflation coming back. Inflation coming back is great for materials. Inflation coming back is great for assets, right? And inflation coming back is actually great for cyclicals overall. And markets' view changes very frequently. So once it changes, people forget. I remember the same stocks were discarded like crazy in 2006, 2007, and they became the darlings for the next 10, 15 years. I have a feeling it will not become, they will not get discarded, but the premium will definitely get looked. Become, they will not get discarded, but the premium will come called inverts and reach. So I'll give an example. Earlier, you had to be a very capital heavy business to be in infrastructure. That's a company called Tata Power. Okay, I'm just taking an example, not per se. The only way you could create value was by building infrastructure, and for that you needed to borrow or you needed. Now what you can do is you can create an InvIT structure there. You can keep on creating assets and transfer those assets to the InvIT. The InvIT investors are specific investors who are different from the shareholders of the Tata Power company who are buying assets at a yield of 8-9%. Now what you have done is suddenly you have converted Tata Power into a capability company from a capital-led company. Your ROEs can go very high, right? Now there is a reason for the stock market to look at you very, very differently. And hence, I think this kind of a model, because of the evolution of InvITs and REITs, might encourage a lot of infrastructure companies to convert themselves into a capital heavy company and a capability heavy company, right? And I see that as a future for some of these infrastructure companies, and hence I think there might be a shift in balance in terms of the multiples for some of these companies coming back.
It'll be interesting though, viewers, I must tell you, please consider Nitin's explanation of Tata Power as merely an example to use to make his point and not a recommendation by any stretch of imagination. So please keep that in mind. But it'll be interesting to see what Tata Power does. They have said that by March they'll be coming out with their InvITs announcements as well. So in a few days we'll get to know. Nitin, one last couple of questions, and one of them is on a space which is highly valued, but people still believe the rate of growth is interesting, and that is insurance. Now, because you guys are closely associated with that business as well, right? Edelweiss has this insurance association for a while, and I just, maybe you've looked at it even more closer. We were looking at this chart which came into the Goldman Sachs report a few days back, which showed that some of the private insurers are at a level which LIC was in FY01. And since then, LIC, despite all of this starting of competition, has grown at a CAGR of 15%. Now, the common refrain is that the insurance companies in India are very highly valued because insurance is well penetrated and the growth numbers need not be that strong and the valuations will come off. That is the refrain that I hear from a lot of skeptics in insurance. What is your sense of what is the landscape looking like for the private insurers over the course of the next 5-10 years?
So I have a slightly different view in terms of penetration in the first place. I think I'll surprise if you do a small check even in your office. You go and check how many people are well insured on a floor in your office. I can 100% guarantee you will figure out that in a sophisticated office like yours, I can assure you 80-85% of the people would be absolutely underinsured or not insured at all. So I think if you ask me in financial services, if there is one industry which is absolutely underpenetrated in India, it is insurance.
Okay.
And a lot of times people say the fact that somebody has an insurance policy means that he is penetrated. That's not correct. Because the amount of insurance is the key. So, and again, there are two kinds of insurance. Like one is life insurance and the second is general insurance. I think we don't even have products, frankly. How many of our colleagues actually even protect our houses, for example? We are so underpenetrated, Neeraj, in general insurance that I think for the next 25-30 years, even if we grow at the current rate, I don't think we would be anywhere close to a developed market. So I think this argument that we are over-penetrated or we are penetrated is something that I will not be able to agree. Having said that, there are concerns around valuations of certain companies in terms of embedded value. So some companies are trading at 4 times, some companies are trading at 5 times, and that's how high growth companies unfortunately trade at. And I can see the rationale for that. But then there are some very high quality companies which are trading at 2 times, 2.5 times. And again, I don't want to get into specific names, but there are a couple of companies that I really love, frankly. And there are arguments that people give, oh, these are union-led companies and hence we don't like them, or these are PSU-led companies, we don't like them. But you look at the numbers, they're stellar. And they keep on growing year after year, year after year, year after year. And my view is in financial services, I think every sector is underpenetrated. Every sector is underpenetrated, first of all. But if there is one sector where I can guarantee you that for the next 20, 25 years, there is going to be growth, that is insurance. So in that segment, I doubt that you will see challenges because of companies struggling for growth. And hence, at some point, the valuations will look okay. At this point, I would not disagree that there's some companies which are slightly above the mean valuations. And if you are smart and you can time the markets, great. But if you're looking at 10, 15, 20 years, and that's how I genuinely believe that one should look at stocks. These are great stocks to buy. I mean, these will compound at 14, 15% hopefully over the next decade or so. In an environment where risk-free rates are 5, 6%, these are very, very solid opportunities.
Okay, that's lovely to know. Nitin, one final word on this interaction then, because there's so many things that we've spoken about. If you were to look for over 5 years, let's say, let's assume 15 years is too long a time frame, and let's look at 5 years. Where is it that you see the possibility of the biggest bang for the buck? And I don't want to restrict this conversation only to the listed space and therefore this sector, etc. The biggest bang for the buck, because the reason I asked this question also is that in a lot of themes, for example, I remember when I'm just looking at Edelweiss, right? You guys, the sell side was amongst the first ones to identify the up move in the specialty chemical space. Then very recently, in the last 12 to 18 months, Edelweiss as a house was amongst the first ones to speak about how they believe that technology, despite the fact that it's such a well-entrenched sector, is in a hyper growth phase, etc. Right? Those are all examples of the listed space, but maybe there are some other pockets as well which look really fascinating. You mentioned insurance as one. When is it that you personally believe that investors could get the biggest bang for the buck over a 5-year or a 7-year period?
No, just because you asked me about and you gave me the luxury of going outside the listed space, I'm sharing this, and I think there are two areas which I find very interesting right now. Okay, one is I think the finally the technology space and the consumer technology space in the unlisted space where a lot of these startups exist. I think are becoming meaningful in size, and I think they will become eventually globally competitive companies. So I do think there are a lot of opportunities to be looked at. I'm again not getting into companies, but there's some very, very exciting companies in the consumer tech space in the unlisted place. And in the next 5 years, some of these companies will be valued at $8 to $10 billion in my view. And even though some of these companies are looking at $2, $3, $4 billion right now, but some of these companies will definitely get listed in Nasdaq, etc. And I think the understanding of that space globally is slightly better. And when I talk to investors there, it seems I can see the kind of excitement that these kind of names are generating in those markets. So I think that will be one hell of an exciting space. And we want, as an investment bank, to be one of the leaders in that space. Now, we have not been very active in that space because the space was very small, to be honest. But now we have decided that we want to play the game, and you will see us very actively in that space. As an investment bank, as an institutional equities house, as a wealth manager, all three, we want to be in consumer tech. The second place that is very simple, but I think it's more cyclical, is residential real estate. I think it's one of the most beaten down asset class in the country. I think demand supply has changed dramatically. I think over the next 5 years, I'll be surprised if we don't see a meaningful uptick in terms of prices in the residential space. So whether it's investment or you're looking to buy a house for yourself, you cannot get a better time than this to buy a house, buy a land, whatever you can get lay your hands on. It's a great time to buy property. Asset prices are going to go up in the next 5 years.
Well, in which case, Nitin, I'll just wrap up this conversation by asking you this, right? I hear, or in fact, we can see, right, a lot of these listed real estate players as well are trying to uh, make their model a more resilient one by not just depending on annual sales, but having the annuity business being a larger portion of their piece, maybe not now, but 3 years out. We've seen that with Oberoi, we've seen that with DLF, we've seen that with Prestige and a few others. Do you reckon that the way the market values some of these companies and the ones which may list over the course of the next 2 years a lot differently than what it values them currently?
I think the valuation models of real estate companies is still going through a evolution. I don't think people have figured out how to value them. Currently, the business model is or the valuation models are very simple. A high quality governance company, which has demonstrated track record in terms of delivering assets and some annuity sales. As a combination of these three, people are giving a value to the company. And I think it's more assessment of the future than giving any kind of a earnings multiple, etc. And because there are only 2 or 3 companies that you can really bet on in this space, but I do think this business model will evolve meaningfully in the similar structure like we discussed earlier. It has to become, the companies have to split into 2 parts. One has to become capital heavy asset ownership companies where the different set of investors have to come in, and the one has to be capability led companies. Actually, you should think of them like R&D companies, engineering companies. Will be very high ROCE companies. And this is my hypothesis of the future of real estate companies. And brand. So if you own the brand, if you own the capabilities, I think those companies will be valued very highly. And these will be like asset ownership in terms of a different set of investors completely.
Well, let's see. Every crisis brings opportunities. Maybe this one has thrown up a bunch of them. Let's see if people take use of that. But Nitin, thank you so much. And I hear about a very interesting product from your stable, the crossover fund, which launches tomorrow. So all the best for that as well. But more importantly, thanks for taking the time out today and speaking to us. And viewers,
it was a pleasure. Thank you.
Of the Talking Point.
Thank you.